My name is Tom Melody. I'm co-head of the finance group at Jones Lang LaSalle, JLL. I think there's kind of two components to policy that will affect the lending markets. First will be the Fed, and the second will be tax reform. So let's take a look at tax reform. We think that's going to have a very, very accretive to GDP growth over the next year or two. We think it'll increase the investment, especially from the individual side, private side. At the same time, we have the Fed, which is increasing interest rates, and obviously interest rates increasing is going to have an adverse effect on GDP growth, possibly. And so I think those would be the two main things we've got to focus on. What's going to happen with the Fed, and then are we going to, is this tax reform is going to be what we all think it's going to be? With regards to economics, we're kind of late in the cycle right now. I think employment is kind of peaking. You're seeing salaries, wages kind of at a high point. And as a result of that, that again has an impact on what's happening in the real estate markets. With the interest rates rising, it obviously has affected the REITs. You saw the REITs recently have had gotten hurt, pretty bad in the marketplace. I think the people are looking at cash flow growth, and I think what's going to happen is that the investment sale market may hurt as a result of that, because the investors are looking for real-time equity returns, and with debt rising, that's going to have an adverse effect on it. They seem to be stable right now. It's kind of too early to tell. Obviously, last year you had investment sales that were down. I think people anticipate investment sales to be down again this year, and that was actually before the interest rate rise. I think you're having a lot of investors out there trying to understand what other options in lieu of acquiring properties may be available. Technology is ubiquitous, so it's everywhere, and it's going to continue to be everywhere. So obviously anybody that's building anything has to have technology at the forefront of their decision-making process. And so I think that'll continue moving forward. That's probably the most significant part. So whether it be, you see it in the retail right now, where you see parking and you have the automated, green and red lights that show the available spaces. You see what's happening with Amazon taking over Whole Foods, and how they're displaying their products and how they're going to be using the display. So when someone takes an item off the shelf, they actually are essentially buying that piece of product. If they put it back, obviously it shows that also. But the way technology is going to happen for retail is already happening. It'll be interesting to see how it plays in the other product types. I think that technology has allowed for smaller offices. The way that people outfit offices, the sharing of offices, the amount of space that people need is going to be less, and I think moving forward that's going to be less also. I think there's some concern over the next couple years as you have the Generation X, which is not as large of a base as the baby boomers, and so how's that going to affect the use of space? Well, the biggest trend we see is everybody's playing in everybody else's sandbox. So you have, the three outside of the agency. So I'm going to step aside to the agencies, because Freddie Mac, Fannie Mae, Ginnie Mae, kind of focus primarily on the multifamily side. So if we take a look at the other product types, you have the life insurance companies, you have the debt funds, you have the banks / CMBS. And so in the past, you had, the banks were playing in the construction arena. Well, now you have life insurance companies making construction loans. You have debt funds making construction loans. The leverage levels. So in the past, you had the bank saying, well, on a construction loan, or we'll do a 50% loan. It used to be 75%, but recently it's been kind of the 50 to 55%, where you're seeing the life companies and the debt funds and even the banks saying, okay, well, we'll do a whole loan as opposed to a bifurcated, first and mezz position, but we're going to lend you all the way up to 75% of the stack for a construction loan. Which is something we hadn't seen in the past. I think you're going to see more of a trend of that because the investors are trying to get yield, and there's so much money in this mezz space that to differentiate yourself, you're going to have to go ahead and basically obligate yourself to take the full stack. If you take a look at the life company space, in the past they tended to do the longer term financing, 10-year fixed rate loans, and so right now you're seeing the debt funds and the banks also doing longer-term fixed-rate loans, again, competing head-on-head against the life insurance companies. And then you have the CMBS, which was kind of doing the B product, the smaller product. Well, they're doing the very, very large deals right now, and in order to compete, you're seeing the banks and the life insurance companies doing, partnership deals with other groups. So you might have 3 life insurance companies coming into play for a $500 million transaction in order to compete against the CMBS market. So everybody's playing in everybody else's space, so it's hard to understand who the lender is going to be for any given transaction. Well, the offshore capital historically has been in kind of the primary 5 markets, and I think moving forward, they're trying to focus on, like everybody else, is how do we find opportunities? And so they're actually going to secondary markets, and it's probably not tertiary markets, but it's probably the next 10 markets. You're seeing the foreign capital looking at products other than office. They're focused with so much office over the years, and now they're saying, well, let's find some alternative investments. Let's do healthcare. Let's focus on industrial. Let's provide other product types that maybe we weren't invested in the past.
Okay, great. So essentially a shift away from those trophy office properties to...
I think they're still going to play in that arena, but in order to get their money invested, they're going to have to continue to deploy it somewhere else. And I think that's the way it is for everybody right now. There's a lot of money out there. International money, domestic, people that are trying to acquire properties, trying to lend on money. And so everyone's saying, if I just do what I've done in the past, I can't get my money out. And so everyone's trying to find a void in the market. And so to the extent that there's seems to be a void in the market, and one of the voids was, construction lending. 50% construction loan. Well, people wanted 75%. Well, how do you do that? Well, you get a mezz component. Well, people weren't doing that, so guess what? You're going to get paid for it because it's all supply demand. If there's a big enough demand for a 75% construction loan, then let's go ahead and do it, but just price it accordingly. And I think that's what's going on. On the equity side, you see a lot of folks trying to say, how do I get a risk reward that's appropriate? And so maybe I don't want to buy at a little later in the cycle. So in lieu of doing that, me as a owner, as a buyer of properties, well, maybe I kind of convert what I'm doing and provide some preferred equity, provide some mezz where I can get, depending on where I want to play in the cycle, instead of buying something at 100 cents on the dollar, I'm going to lend at 80 cents on the dollar. And that's across the board, all investors, debt, equity, foreign, domestic. Business models are, what do we need to do to get the highest returns for our investor on a risk-adjusted basis? And it may not be doing what they were doing in the past, and it may be going into some different areas. So you take groups like a JP Morgan as an example, and they're making debt investments, they're doing equity investments, they're doing mezz, they're doing full stack investments, and Wells Fargo doing the same thing. But you're seeing other groups, life insurance companies now, that they tended to just want to do a 50% loan on a fixed rate basis on the best product. They're saying, well, maybe we've got to do something a little bit different in order to get as much money out as we need to do. And so they're going to go look at doing some different things also. They'll do construction loans. They'll do full stack construction perm. They'll do 80% 75-80% leverage, but they have a mezz component or preferred equity component to it. So it's an interesting time in the marketplace, and no, there's no one capital source that's the logical option for anything right now. Freddie and Fannie did about $140 billion last year. So they continue to be dominant. They increased their volumes about 30% over where they were in 2016. The CMBS market did close to $100 billion last year. I think expectations are fairly flat, even maybe down a little bit. I don't think it's going to be a big deal, but you had, I think, about $120 billion worth of CMBS loans maturing in 2017. You only have about $20 billion maturing in 2018. I don't think it's that big of a deal. I think a lot of those loans got, paid off earlier in the process. You have the banks that continue to dominate the space, like they always have, with probably about $300 billion of lending. But they're, again, doing a lot of different things than they had done in the past, as opposed to just construction loans. And you see the life insurance companies are doing about $75-80 billion. That's kind of a number that they have done for years, and so that number doesn't change too much. It might go up a little bit, in 2018. If you said, guess your numbers, that's you put $80 billion, and that's probably a pretty good indication of what it'll be. And so the debt funds probably the biggest increase over the last several years. And the debt funds is a variety of different capital sources willing to do mezz and preferred equity and maybe even some JV. And so that space is the growing space. JLL as a company has continued to do more and more of that.